Okay, I'll start with some introductions first. So Gordon McArthur, CEO and founder of Beeks Financial. Started the business in 2011. Some people I know around the table already, but my background previous to Beeks was I worked at IBM in various senior commercial roles in the software business for about 10 years, and always had a kind of side hobby and interest in financial markets, and hence why Beeks started. Fraser?
Hello everyone, Fraser McDonald, CFO. I've been with Beeks for 3 years now. Came in originally to help support with the IPO process and went full-time after a year as Group Financial Controller, and then I've been the CFO since October last year. Prior to that, I worked in a division of Serco PLC, a company called Access, for 7 years, where I was at the end head of finance and a couple of commercial accountancy roles in there. Prior to that, I was with National Australia Group for about 5 years.
So Beeks Financial Cloud, we are a cloud computing company that specialise solely in financial markets and live in a smaller subset of just the financial markets. So we support the trading community, whether that be buy side or sell side. So historically, the business started in the retail FX environment, where we provided a white label service for retail traders, predominantly running the MetaTrader platform, running algorithms, and we white labeled our service to most of the big FX brokers around the world, people like FXEM, Gain Capital, IG, and the business focused on that for the first 2 or 3 years of our existence. We always had ambitions to scale the business, and that niche didn't allow us to kind of get to the scale that we always desired. So after 3 or so years of predominantly or only doing retail FX, we pivoted the business into institutional hosting and connectivity, which is where we focus on now. We still do some retail, we always probably will do, but the focus on the business going forward is the institutional hosting or infrastructure service and connectivity play. So the business model is actually fairly simple. So our cloud now operates out of 11 data centres around the world. The soon to be 12, as you've seen in the half-year announcement, that we have committed to Bovespa in Brazil. So we're looking at rolling that out in the short term over the next period. So when we deploy our cloud in a data centre, we pick the data centre specifically to be in the same data centre as exchange or trading venues. So in financial markets, that ecosystem tends to congregate into specific data centres. Some of them are owned by the exchanges themselves, like SGX or CME, and Bovespa own B3. Some are financial data centres specific, but owned by third parties like Equinix. So we deploy our cloud infrastructure in the data centres, and our USP has always and still is the direct connectivity between our cloud and the financial exchange or venue. So we have around 230 or so direct connections now from our 11 data centres. And what I mean by direct connection is from the edge of our cloud environment or networking stack, we run fibre up over the internal data centre roof and down into the exchange. So that provides a secure private network between our cloud environment and the exchange or trading venue. We then sell that as a service, and that comes linked with our infrastructure. Over the last 2 years, we've invested significantly in our self-service portal, and we'll talk about that quite a lot as we go through the deck. So it's fairly unique in our certainly financial ecosystem, where we are now providing clients the ability to deploy and manage infrastructure themselves. So the virtual machine side of the business was fully automated as of the summer last year. We finalised the dedicated bare metal side probably only in December of 2018, where we're fully happy with it. So clients now manage bare metal dedicated machines and virtual machines themselves, provision them themselves, buy them themselves, and destroy them themselves. The next part of that project, is to automate the network stack. So that is being sized currently, and over the next 12 to 18 months, that's one of the big projects that we're working on is full automation of the kind of connectivity and VPN setup that allows automated connectivity provisioning. So that's a big project. And the portal has allowed us to win business and continues to allow us to win business ahead of our competitors. So it's a strategic focus for us as we go forward. So yeah, I mean, with the infrastructure as a service provider, we are the network and compute providers. We don't provide applications, we don't provide liquidity, we don't provide any sort of trading application infrastructure or get involved in trading itself. We are the plumbing that makes it all hang together. So next slide, market opportunity, slide 3. And this is, you know, this has still not changed since IPO days. So we believe that the size of the market is fairly significant for us. We think there's up to 20,000 financial institutions in our space that are potentially interested in our services, not saying for a moment that everyone is. We currently have around 210, 220 institutional clients. That's grown since the last report. But still, we believe only 1% of the market. And previously, and again, we'll talk about what we class as tier 1 quite a lot today. So previously, and even before, you know, the last report, we had 0 tier 1 clients. We announced in December that we had signed our first one. So we now have referenceability and conversations going on in further tier 1 institutions. So that market pre-IPO was pretty close to us because of our size, shape and scale. But we are now making a strategic focus on that as a business to unlock some of the larger institutions in London, New York, and all around the world. And yeah, so it doesn't give us any more clients to go after, but the revenue opportunity associated with the tier 1s is kind of night and day compared to our usual, you know, average customer spend of a couple of £1,000 a month. You know, we believe the size of the opportunity in front of us is still relatively significant. We have made some strides into the cryptocurrency market. Still less than 5% of our revenue. We made an announcement this morning on a deal that we have closed in February that we've been working on for the last 4 or 5 months, and we're moving the BQuant crypto exchange into their matching engine is moving into LD4 environment, and then they're offering our bare metal and colo facilities to their end clients. So. That's an annually committed deal. It's not the biggest deal in the world. It is, you know, it's significant because they're an institutional crypto exchange and growing very quickly. So we're having
with the collapse in cryptocurrency prices. Have you seen a reduction in trading volumes?
No, I think if you look at the overall, despite the price of coins, the overall volume of cryptocurrency is still going through the roof. So. You know, we are not betting the entire business in cryptocurrency. I think, you know, 10% of our revenue may come from hosting crypto type activities. You know, there's hundreds of exchanges that have crept up, and there's a lot of VC money going into cryptocurrency still. I'm not necessarily 100% certain that there'll be hundreds of exchanges in a few years, but we're seeing no slowdown in the volumes in crypto market or the conversations going on in the crypto asset class. So, yeah, I mean, you know, as I say, we're kind of broadening the asset classes, and we have done for quite some time. So if we move to slide 4, this is our current global footprint, a slide that a lot of you guys have seen before. We don't have Brazil in there yet because it's not live. You can't purchase it yet, but Brazil will be our first foray into South America. So the small red triangles you can see are our data center locations. We have the black lines are the wide area network that we've been implementing and is now fairly mature, that connects all the dots, well, mostly all the dots around the world on a secure low latency wide area network. So if you want to send market data from New York to Tokyo, London to Frankfurt, then we allow you to do that in a secure and low latency manner. So we also sell that WAN as a service on a month-to-month cloud basis. We are continuing to explore new geographies. We did look at ASX in Sydney, but the demand didn't necessarily allow us to do it. Brazil was a very obvious answer, and the way we decide on a new geography is we go talk to our client base, existing ones, and ask them if it's of interest. We look at the commercial decision is if we can get a new site to monthly operational break even within 12 months, then we will do it. And you know, we need committed contracts from our existing clients to allow us to do that. So that's the way we've expanded, and that's the way we'll continue to do. There are other locations we're looking at, but I think Brazil for the medium term, and we've got the expansions in New York and London on the go at the moment, will be all for the kind of shorter term for this period. So highlights for the first half, and then I'll hand over to Fraser. So I'm using the word solid. I think there was if you look at year-on-year performance, all the key metrics are up 30 to 40% compared to first half last year. Some areas of disappointment. I think we're finding more and more we're becoming a second half seasonal business, and the reason for that is pretty simple. So historically, we have dealt with retail traders who don't really stop trading over the summer. And then as we moved into the mid-market, deals of £1,000 to £2,000 a month, they just kind of come in all the year round. There was no real seasonality to it. And you get into the bigger side of that when sign-offs become a bit more involved, procurement become a bit more involved. What we're finding is July and August, our first 2 months of the year, which has implications because it's monthly recurring, are basically write-offs because the City of London closes. No one, if you're trying to sign a £500,000 commitment, there's nobody here to sign it off, and things materially slow down now in the top end of our sales cycle in the 2 months, and we see the same in December, because if you don't get it done in the first week of December, you're not getting it done. So that first half basically condenses now down to us for 2-3 months of selling time, whereas the second half of the year, there is no slowdown. You've got the full 6 months. So previously, and again, we didn't see this coming. We should have, but we didn't. Hindsight's a wonderful thing. More and more, and we expect it this year, it became very obvious last year, we will be second half weighted. We are seeing it already, that the pipeline is hugely strong going forward, but the first half, July was disappointing, August was disappointing. So, first half, it is what it is. We expect the second half to be much more weighted to new sales activities than the first half was. But that knock-on effect for having July and August, and we did see we had a couple of longer-term clients go out of business in July. So we'd seen about 15 grand a month of cancellations and a very slow month. So that kind of has a knock-on effect, and that's why the revenue was off a little bit from our expectations. It is what it is, but we hope to catch up in the second half, as we did last year. So we continue to expand into the asset classes. We've opened 2 new data centres this year, London and Singapore, with Brazil committed and going through the planning and implementation phase. It will be a slow deployment. Brazil is a difficult country to do business in for various reasons. So we are taking our time rolling out to Brazil, but we have committed revenue there already. Interim dividend committed. We continue to have a progressive dividend policy, and we will continue that as the business scales and grows. And really, the pipeline that we are sitting with at the moment is night and day compared to what we had 2 years ago. I think the fact that we're now PLC status has slowly changed the narrative in some of the conversations we're having. We have, I keep saying this, but we have significant tier 1 opportunity at the moment. It just is taking longer for us to close them out and deliver them. And we hope to make some updates on some of the tier 1 situations over the next period. But overall, there was good and bad in the first half. I think if we had managed to not have the cancellations in July and August, and we had a decent couple of months then we wouldn't have had to pull back the revenue and some of the profit numbers that we did. But going forward, we're in a stronger position than we've ever been. More than happy overall with where the business is at, and we are seeing a game-changing dynamic in the sales pipeline. So I'll hand over to Fraser to go over the financial results and the numbers, and then I'll come back to me for some of the other closing slides.
Okay, slide 6. So as Gordon says, I think if we're honest, a sound set of financial results. So revenue's up 30% and profits up in the mid-40s in a period where we also invested is a pretty decent set of numbers. The revenue is a bit behind where we'd like it to be, but we believe it's a decent first half. So EBITDA up 49%, PBT up 46%. Profit margins, so our gross profit margin 49%. If you looked at it last year, for the full year, it was 53%, so it's taken a slight dip. Part of that is, being slightly behind in revenue, but also the fact that we expanded into Singapore and London, so that had an impact in margin by about 2 to 3% as well. So, as Gordon says, second half of the year, we expect those margins to uptick as the revenue is higher in the second half of the year. The cost base will be relatively flat in the second half of the year. So again, we're looking for those margins to kind of come back to full year levels, more akin to last year. Okay, any questions on slide 6?
Why did you lose those clients? Were they just
out of business? So there was 2 clients that actually just went out of business. So it's out with our control, and timing wasn't great. But
Why pay a dividend if there's so much growth ahead of you?
Because we generate cash. We always said as we IPO'd that we would be a dividend-paying company. The dividend doesn't affect our ability to tackle growth.
Okay. Turning on to slide 7, some of this has been said already. So it's been a period of growth for us over the past 6 months. So we've mentioned the data centres. We've also invested in our portal, which Gordon talked about earlier on, is strategic and is both sort of cost avoiding in terms of automating the process in terms of self-serve, but also attracting customers in as well. The pipeline has increased materially. The tier 1 opportunities are there. We've mentioned that already. And we are looking at a stronger second half because of the weighting and what Gordon's mentioned earlier. I think a lot of this actually has been already talked through in terms of slide 7. Looking at the income statement, the graphs are going in the right direction. So the graphs showing turnover, profit and EBITDA. Again, just maybe calling out a couple of things. You'll see that our depreciation and amortisation has gone up quite a bit in terms of our prior period, again reflecting the fact that we have invested Singapore, London Interaction, the 2 new data centres, and also the portal, which has had an impact in margin. But again, looking at comparative to last year, we are up 35% revenue and 45% profit. Okay.
Is there a good balance between your depreciation and your replacement of?
In terms of the life cycle replacement?
Yeah.
So it's about 80-20 in terms of new to kind of replacement that we factored in. Yeah. So it's most 4 years for our assets. Capacity, do you want to talk about capacity, Gordon?
Yeah, so, we're always going to have to front-run capacity to a certain extent. I think if you look at it, it's fairly obvious from the diagram, we are looking at expansions both in New York and London at the moment. And they're our largest sites. We commit to private cages in these sites rather than single rack deployments. So, we've got 6 racks worth of capacity. We would never get that, we will always need to front-run a level of capacity, but the operating costs for that capacity is sunk at the moment, and it gives us about 2.5 million of revenue. That once we fill that space that we've got, then that's roughly the revenue that we would see attached if we filled up the remaining space that we've got. But we are about to extend significantly in New York and London because they're our most popular sites, and we're kind of getting towards outer space in both.
Okay, maybe just flipping on to the balance sheet, slide 10. So graphs depict net assets, fixed assets and debt. Just calling out a couple of things. So our fixed assets, you'll see 2.1 million. 2.1 million in June last year. However, there's been about £450,000 worth of investment in there, offset by depreciation. In terms of our cash, so we still have 2.4 million in the bank. So our cash has been funding our growth, but we still have sufficient cash reserves to meet the next sort of 18 months or so at least. Maybe calling out leases and loans. So we took on a number of leases prior to IPO. We literally had no money, but we've been paying those down. We've not taken on any debt since IPO. So if you look at the kind of percentage of our leases and loans of about 560,000, 427 is going to be repaid within the next year. So we are bringing down the debt in the business.
And what's the board's view on level of debt?
Well, other than M&A activities, which we will deal with on a case-by-case basis, we have no, the desire is to have no debt. that what we do in M&A land will, yeah, it's a different conversation. But we generate cash. We're a profitable business. We are not dependent on debt. Never will be.
Okay, flipping over to slide 11. Cash flow. Cash flow is relatively simple for the first 6 months of the year. So effectively, our operating cash flow has paid for our investment. So if you look, net cash before operating activities, £600,000, and we invested most of that, a wee bit more than that, in terms of our assets, and a lot of that, part of that was Singapore, which is about 150,000, and then expansion, over our other sites in terms of, putting in the servers to meet the growing customer demand, and then 200,000 was invested in our portal. And then after that, we have, as I said, we've been repaying our loans. So, we've repaid about 235,000 in borrowings, and we paid our dividend. So, opening 2.9 to 2.4.
Quick question on the tier ones, and as you sign more of them, hopefully, what are the implications for your working capital going forward?
Yeah, I mean, and tier ones, you probably dealt with this as well. So, if I take the case study that we had, in terms of the CapEx spend, it wasn't significant for us. And the OpEx spend, again, we were talking about £7,000 or £8,000 a month. It wasn't a big impact in terms of that.
It depends. If we have a big bank that comes in and says we want 700 nodes of server compute between NY4 and LD4, then we need to go and spend £1 million, £1.5 million to do that. But it depends on what the deal is. Some of the deals are infrastructure, some of them are connectivity. So infrastructure has a big CapEx footprint. Connectivity is more operational spending. So it just depends on the deal. And there's a mix of the conversations going on at the moment. So hard to say. So on to strategic priorities.
Over what period are you amortising?
5 years. 5 years.
What are your CapEx requirements going to look like next 2 or 3 years?
So next year, I think we've got it about 1.6. We've not gone further out than that just now. So a bit more, not significantly. So that's probably about 20% up on current year.
And that includes the software development spend as well.
No, that's pure CapEx.
And
that's kit.
Additional spend on.
It'll be similar. So it'll be will it be? We'll probably increase the size of the team. There will be. Maybe how many people? I think we've got one. We've budget for one software developer.
We've got two. Depending on, we've got budget for a couple. So that team will increase by a couple of heads. So I think there's 6 software developers at the moment. We'll go to 8. Depending on something else, that might need to scale a little bit more. But a head count for a couple. So strategic priorities, slide 12. So the big thing for us is the tier 1 space, and whilst obviously I can't go into detail on the specifics of what we're talking about, the size of this market is huge. I mean, I think the rumours are Citibank spend about $1 billion a year on their trading platforms, their infrastructure and their trading platforms, and that's just one bank. So I'm not saying for a second that we're about to go and Citibank are about to outsource their infrastructure to us, but that gives you the size of some of the numbers in that space. And going back to why we IPO'd, it was the key reason. It was never okay, we had some working capital constraints, but we could have got an injection of funds. The whole reason we did IPO was to try and gradually move up into that tier 1 space. It was always where we wanted to be. And I think we have made great strides over the last 12 months specifically, and the next year to 2 years we hope to become one of what's known as the incumbents in that space, and that's a significant opportunity for us. Not saying, as I say, that we're walking away from the mid-market. We'll continue to run that small deal engine, and there's still significant headroom for us to grow there. We will focus on a few new data centres over the next period. Getting Brazil in and live and revenue generating and profitable is obviously one of our priorities. More hybrid cloud management deals, fine. The more and more out there, becoming more and more prevalent, more and more common, and we are happy to manage hybrid cloud deployments for financial services customers.
Will you market specifically, or will you rely on telcos to introduce your?
No, but we are starting to market and advertise it specifically, and we're working with Equinix and some of the other kind of cloud exchanges to to do some marketing in that space. Equities. So equities is still the missing asset class. We've got a couple of war wounds in terms of M&A over the last 12 months. We've not done a deal. It's not to say we've not been close, but a couple of things have fallen down in due diligence. So we still don't have what I would say is an end-to-end equities play. It's the asset class that's missing. We still will not do that organically. So it's still an area that we're looking at. And we have got headcount for 12 or 13 people over the next year as we scale. Backup as a service is now in beta phase with our first client in London. So they are starting the beta testing next week, and we hope to launch that formally in both London and New York over the coming 6 to 8 weeks, and that will be an additional revenue stream for our existing clients. Investment areas, the portal, it is unique, and some of our competitors fear what we're doing there, and have asked us to have conversations around working together rather than competing. So it shows that what we're doing there is interesting. We're always looking at adding value around the core infrastructure service offerings. So, M&A. Yeah, a level of frustration that we've not got a deal over the line, but the couple that we've got to due diligence showed fundamental issues within the accounting of the businesses. So we rather that come out in due diligence than after the fact. So it's not for the want of trying, but we've yet to nail a deal that we go back to the 3 golden rules. It's growing, it's profitable, add values, and the accounts actually make sense. That's the 4th one now. And we continue to explore M&A. We continue to look at it. And then kind of last couple of slides from me, and then we can move on to some specific questions. So because we keep going back to this tier 1 market, I thought it was worth a slide specific to it. As I said before, there's very obvious why we couldn't get near it, but as we're growing, as we're maturing, PLC status has helped us a lot. The referenceability now, I can't understate how important that has been. But there's also a lot of stuff going on in the background. We're going through ISO accreditation. After that, you look at SOC 1, SOC 2. All of these things help these conversations with these large institutions who've got huge compliance and regulatory overhead around the infrastructure that they're deploying. So we are going through that process. I think on the tier 1 we signed, we went through a full vendor management process. Over 400 questions for us to even get on the books as an approved supplier. Again, previously, even a year ago, we would have fallen down on a lot of the questions. So there's been a lot of work in the background, specifically run by Paul, our COO, who's done a great job, to get us to a state where we have the documentation, the process, starting to level accreditations that these financial tier 1 institutions need to see to be able to work with a company like Beeks. But the downside is it just takes longer, and unfortunately it's had an impact. But we think and we hope over the longer term, signing 1 or 2 of these larger institutions moves the needle considerably on our organisation. We're not putting that into the forecast at the moment. That's the kind of as is state. But we hope because they don't do it big bang, right? No bank is going to come to us and say, tomorrow we are moving 1,000 servers to run a fixed income platform and need it running in 6 weeks. That doesn't work. Doesn't happen.
I suppose one of the challenges you're going to have, and you've had since you've IPO'd, is making sure you forecast as conservatively as possible, and that becomes even more important when you've got tier 1. So. Yeah.
And the forecast. I mean, our business has evolved even since IPO, and the forecasting is a challenge. We've not been perfect at it because things have changed, and the way that our business has matured has changed that we never foresaw. But we are, the forecasting has been a challenge, and while we try and have a realistic forecast. We're not about to say that, you know, we're going to, there's a multi-million-pound deal that's heading in the next month.
And maybe a glass half empty approach to forecasting.
Can you say something about the impact on the gross margin that the Tier 1 will have in the second half year on year? Because obviously
I mean, it's not going to have much of an impact at all, you know, the Tier 1. The current stuff, the potential new business, Gordon, that's maybe, in terms of any new wins from that current, you talking about the current Tier 1?
Yeah, because obviously it came on in December. And
yeah, oh, sorry. So in terms of the revenue recognition, it's about half. It's about half recognised just now. So there's still about half to go.
Yeah, I'm new to the company, but you obviously had a significant gross margin increment in the second half of last year.
So if you look at last year, it's slightly skewed. So yes, if you look at the gross margin last year, there was quite a number of supplier credit notes that we received in the second half of the year. So if you're looking at last year, I'll just look at the full year, because it is weighted. If you look at the cost of sales, are actually less in the second half of the year, which we would not normally expect. So that margin, I think, you can almost discount. It's more timing than anything.
And last couple of slides, and then we'll go to questions. So slide 14. This is our biggest client at the moment, and they're not a financial institution. They are a fintech application provider. They provide liquidity management solutions to large FX market makers, and you know, it just shows the kind of slow and gradual increase of how people use the platform. So 2 years ago, single server, single cross connect in London. They were a startup that kind of formed out of Deutsche Bank. And they have done incredibly well. So every time they sell their software, their stack, we get a couple of servers and 10 or 12 cross connects, and they're now worth 40 or grand a month to us. They have no interest in doing the infrastructure component. We deploy for them quickly. It allows them to onboard their client, and they sell their application very quickly. We hope and expect that graph continues in that nice fashion up until hundreds or 100 or whatever grand a month, so what this shows is some of the onboarding we're doing at the moment is okay, so maybe only 10, 15, 20 grand a month, but we hope that graph then propagates over the next 18 months to hundreds of thousands of pounds a month, with some of the bigger clients that we're signing now. As I say, and so we've got a specific tack to go and target these fintech providers that need a level of low latency infrastructure, because it's as they scale, we scale, and it's a nice model. We work very well with them. And the same on slide number 2. It's just a slightly different model. They just take lots of computer from us around the world, and they're a large FX software provider who we've known for a very long time. Summary and outlook. So, we continue to be profitable. We continue to focus on growing profitably. Half one was a period investment. Year on year it was good. Obviously a little bit shy of the forecast. But I think, as we sit here in February, I'm more confident in the outlook and the business than we've ever been. The stuff that we hoped would happen after IPO is slowly happening, just not as quickly as we'd hoped. And we do believe that we've still got a decently high barrier to entry with the services that we offer, and building out that IP through the portal and some of the value add services that we're now tagging on makes it an even stickier business, and we will continue to invest to try and set us apart from our competitors. And that's me, so happy to take any questions.
All the hoop jumping that you had to go through to get the accreditations with the Tier 1, is some of that replicable?
Yes.
So it's not quite the same process.
Yeah, so a lot of the things we had to do were processes that we had internally that are agreed, not necessarily documented. So a lot of it was around process documentation. Shows your InfoSec policy, and we have an InfoSec policy. But having that documented was not necessarily fit for purpose to go in front of a large client. So that has all been done now, and we can lift and shift that into the next engagement. So hopefully it speeds up the process from that point of view.
The forecasts have been pulled back, obviously.
Yeah.
to what extent are Senkos's forecast dependent upon landing these elephants, tier ones?
The kind of proof of concept stroke pilot phase, there's a few of them in there, but what we're not seeing in that Senkos forecast is, we're going to land a monster in the short, that's not baked into it. So it's more still the run rate business with a couple of chunkier initial tier one opportunities closed. And the problem we've had with the forecasting is not only getting it closed now, it's now when do we start recognising that revenue, because what we're learning and what we were a bit naive, and I keep saying we're naive, we were, is even after signing the contract, it's going to take three months, maybe shorter, maybe longer, to actually get that revenue on the books, and that's provided an impact. We probably didn't model that as well as we could have, because we hadn't been in the space before.
So has that been removed from the Senkos forecast now? So
the Senkos forecast is what we realistically think we will do over the next few periods without landing a monster. So that is taken into account a bit of the slack, and that's why we pulled it back a bit, is because we have to take account of it's going to take 4 months to deploy this stuff and get it on the books, as opposed to usually we can book the revenue 2 days after we sign the contract because we've deployed it and we've sent it to the client, and that's what one of the reasons why we've had to pull it back a little bit.
Could you possibly put these two customer examples into some context, just in terms of percentage of revenues for this year?
They're both, are two of our top customers. So our top customers about 6% of our total revenue. So they're two of the biggest customers. But again, the journey was to show that they started, a few £100 a month, and they've now grown to to that size.
So, based on the current forecast, and these two customers are increasing their percentage of the overall revenue that you're going to be.
So when we look at next year's forecast, we've taken a bblended view overall of average increase per month. That's how we forecast it. You could probably be a bit more scientific and look at customers and growth. Ultimately, we think it makes more sense just to get an average growth, monthly growth.
And we're open about it. I mean, it's 18 grand a month net new revenue each month, deployed, booked. New revenue, that's the target for next year, and that's minus cancellations. Okay, thank you, folks.
Thanks very much. Excellent.